Hello and welcome. You're watching The Money Show, your one-stop destination for your personal finance queries. I'm Kavita Thapliyal, and as always, we are going to be talking about investment strategies for your financial portfolio, and we'll also do your life financial planning on the show. And you can also send across your question, connect with our experts, talk to them, and get a customized financial strategy for all your financial goals. For that, all you have to do is just send across your queries on our WhatsApp number, which is 865-797-4571. We also have an email ID where you can send across your question. The email ID is themoneyshow@etnow.tv. All right, so let's begin the show. And market sentiment remains robust. Investors are increasingly turning their attention to arbitrage funds. And today, that's the focus of our discussion also in the first segment. Arbitrage funds, a hybrid investment vehicle that seeks to capitalize on price differentials in various markets. Now, arbitrage funds have garnered attention for their potential to offer stable, low-risk return by exploiting inefficiencies between cash and derivative markets. Moreover, their classification as equity funds for taxation purpose provides a favorable tax treatment, making them an attractive option for investors seeking both safety and efficiency. So, in today's discussion, we'll explore the mechanics of arbitrage fund, their performance in the current market climate, and how they compare to other investment avenues. I have with me Sailesh Jain, Fund Manager Equities, Tata Mutual Fund. Hi Sailesh, good evening and welcome to the show. We'll start with a very simple and a very basic question, on arbitrage fund, because understanding arbitrage fund is the first crucial step. What exactly are arbitrage fund, and how, in terms of functioning, how do they function to generate stable returns for investors?
So hi Kavita, thanks for having me here. Just to start with, so arbitrage funds are nothing but creating riskless profit. To start with, how does it function in the Indian equity market? It's basically someone, a fund manager on for the arbitrage fund, will try to find price discrepancies between the equity market and the futures market of the same underlying. Now, this is for the initial step. So let's take a hypothetical example. If the equity market, assuming a Reliance share is trading at 100 rupees and the futures of the Reliance shares is trading at 101. So this is what the opportunity exists. Basically, the 1 rupee difference between the equity market and the future market is where the opportunity lies. Now, how does the trade work? Basically, the fund manager will put an order or will actually execute to buy the equity shares, and he will simultaneously short the futures, basically sell the futures. So that way, what you're doing is you are actually hedging yourself completely, which means there is no price risk. And the difference between the equity and the cash, between the equity and the futures market, that is the 1 rupee, is your profit, which is you have locked in. Now, this profit, because you have the futures will generally be will be having mean reversion, which means they are priced on the underlying. So during the expiry or nearing the expiry, the futures will start converging near the equity markets. What SEBI has also done is that with physical delivery coming in, if you are a short futures, on the day of the expiry, if you don't do anything, you will need to furnish the delivery against it, which means there is virtually you don't have to do anything if you have to square off your position. The futures price will theoretically close at the underlying, which logically means that the 1 rupee which you have captured at the time of the initiation of the trade, that is 1 rupee, the difference between the futures and the cash, is actually your logical profit at the expiry. So in theory, there is absolutely no price risk in an arbitrage fund. It is just the spread which you capture and is your profit, and that is actually captured at the price at the initiation of the trade.
Sure.
So in theory,
Uh,
it's a simple fund
sure.
to understand. You have no
Absolutely.
price risk at all on this fund. Yeah, everything is hedged on this
Absolutely.
product.
Right. So that's the advantage, that's there. The hedging really plays a very important role. But then having said that, I also want you to help our viewers understand the different market conditions, where an arbitrage fund can reduce the risk. In what market scenarios do arbitrage fund perform optimally according to you? And when might they underperform also, for investors' understanding benefit?
So for an arbitrage fund, any scenario which is a bullish scenario is actually a very ideal scenario. So if you have a trended market where the spreads actually, so in theory, what happens is in a trended market you see a lot of market participants coming in, which includes the retail and the HNI, and in generally the spreads widen because of the leverage trades. So a bullish market is actually a very, very good scenario where your spreads, what I mean by spread is basically the difference between the equity market and the futures market actually widen. That's a very good scenario for the arbitrage market. A bullish market or a volatilely bullish market, which we are in a current scenario where you see the market moving up, but there are bouts of volatility during the month, is actually again a very good market for the arbitrage funds because one, you capture in the spread when you set up the trade, but during the month, because you have a lot of buying and selling throughout the sector rotation or you have the market cap rotation, in generally you get early exits than waiting at the expiry. What is not a very good market is actually a bearish market where you see markets nifty falling by around 5, 10, 20, 15% in a month, and that will be a very, very bad market because there where you will see lack of buyers coming on the futures market or lack of buying on the equity market, generally creating low volume in the market is actually not a very good market for the arbitrage funds. But I want to reiterate that any point in time, whichever the market is, there is absolutely no price risk on the arbitrage funds because everything is hedged right from the initiation.
Sure, sure. So when we talk about comparing this particular category, how do arbitrage fund compare with liquid funds and fixed deposit in terms of liquidity, safety, and also returns? Sailesh.
So good question. I think that's a fair question. To start with, let me put it simply. Fixed deposits are fixed deposits. I think everybody's aware of what are fixed deposits. On the liquid fund in generally are categorized as debt funds and they invest into papers with maturity lesser than 91 days. Now, because they are considered as debt funds, they are taxed like where your holding period is less than 3 years, you are taxed as your marginal tax rate. Anything which you hold beyond 3 years, you are taxed at long-term capital gain tax. Now, on the contrary, against it, for the arbitrage fund, basically arbitrage funds, because they are categorized as equity funds, you have a long-term and short-term similar like to an equity fund, which means if your holding period is less than 1 year, you will be taxed at 20%, which is the STCG, which is the short-term capital gain tax. Whereas if your holding period is more than 365 days, you will be taxed at long-term capital gain tax, which is 12.5%. So clearly there is a tax arbitrage for an arbitrage fund. In terms of safety, I reiterate the fact that everything what we invest into an arbitrage fund is hedged from the initiation of the trade, which means there is absolutely no price risk on this fund. The only and whatever profits you have captured right at the initiation of the trade is actually your profit, which will be realized on the expiry or before the expiry. In terms of liquidity, arbitrage funds, because they are under the fraternity of the mutual fund, the exits and entries are as simple as that. Only thing is that your holding period, if it is less than 30 days, there can be some exit load as per the mutual fund individual AMCs. But after the 30 days period, you are free to redeem any point in time without paying any exit loads. The only tax which I reiterate that the short term and the long term is what will be taxed to you. But having said that, when you compare with the liquid fund, I could honestly put it on in terms of risk in par with the liquid fund. But as far as the returns are concerned, they will definitely be higher than the liquid funds because one, they have the tax advantage. Second is they also gain because of the volatility of the equity markets.
Absolutely.
And on
Sailesh,
the fixed deposit,
sure,
uh,
sure. Yeah,
sorry, I just
yeah,
wanted
yeah,
to on the
please.
fixed deposit. Fixed deposits are
Sure.
again considered, they will again be taxed on your marginal tax rate. So in term,
Okay.
the tax advantage works beautifully well for an investor. Second is obviously there is a
Mm-hmm.
probability of getting your higher returns because if the
Mm-hmm.
markets become volatile, arbitrage funds can generate higher returns also during those
Okay.
periods.
All right. Sailesh, I also want to understand the composition of your arbitrage fund. Equity and debt, what's the kind of exposure like? Within equity, is it a strategy of a flexi cap that's been opted? What are the sectors that we are looking at? If you could just explain the entire portfolio of your fund right now.
So thanks for this. So what that is actually a differentiating factor what we have between us and the arbitrage fund. I think hypothetically that has also helped us to outperform the other arbitrage funds. So let's take a very simplistic approach. Supposedly someone invests 100 rupees into an arbitrage fund. The first 15 to 20% of the money will go into the margin. Basically, this is the margin which you need to keep with the exchanges for the futures position which you will be taking. 65 to because it's an equity text fund, you need to give at least 65% of your money into equity and equity related instruments. So the 65% money, 65% of your money up to 70%, 72% depends on the fund manager choice, will go into the cash future or the equity future arbitrage strategy. The balance can actually stay into debt and cash. For me, in my fund at the moment, I have close to 16, 17% of my money into margin, which is basically nothing but deployed with our own mutual fund schemes. I think everybody has opted that for now when the FDs were stopped. The balance 66% of the 66 to 67% of my money is into the equity future arbitrage strategy. The balance is parked into debt and cash now.
Okay.
What is also important is that I follow a portfolio approach into managing the equity and the future arbitrage portfolio. And what I mean by that is that for me, it is very critical that in which market cap I invest money. So I have a thorough study when I put in money. And what I mean by market cap is basically how much of my money should be deployed into large cap, mid cap, and small cap. That's strategy one. Strategy two, in terms of portfolio construction, it also depends on which sector I put into money to it. For me, it is very critical to be assured of the fact that the sectors which I put money into, and again, reiterate, everything is hedged. So when I mean by sector, basically, if the sector is in favor, one, the cost of carry is extremely good, which means my returns are slightly higher than the peer. And second is that if the sector is in favor, there is obviously a lot of churn possibility into the sector, which means people will move from one sector to another sector, one stock to another sector. That gives the advantage or that gives me the option of actually exiting the trade early rather than waiting for the expiry, which means I have the option of enhancing my return. The third one, which is also a very critical part as far as managing the arbitrage funds, is basically the corporate action. So that is typically those are their dividends. So if a stock is giving you a dividend, and if your assessment of the dividend is correct, you can enhance your return on the arbitrage funds as well. So in theory, we have been successfully doing all these three things quite well, and that has been the core of our managing this fund.
Sailesh, I also want to understand now, since we are talking about arbitrage fund, what's the typical exposure in terms of your portfolio one should be given to an arbitrage fund? When we talk about a financial portfolio, you have market cap specific funds, but how much of a weightage can be given to an arbitrage fund? Are we looking at these kind of funds to give stability to our portfolio, or you think, a chunk of money, you can use it as a pure debt fund, as explained by you also earlier, because it's quite better as compared to a lot of categories in debt funds and compared to a fixed deposit also. If we are looking at a time frame for say 1 to 3 years, can these kind of funds be considered, or we are just looking at a longer duration investment in an arbitrage fund?
No, absolutely. So your question is pretty valid. Any investment so basically, let's put it simply, arbitrage funds can definitely stand tall versus your liquid, ultra short, or the fixed deposits for now. But you need to understand that this can't be a shorter entry exit type of funds. If your investment horizon is more than 3 months and anything beyond that, then arbitrage funds generally give you way far better return than the comparable categories, which is basically nothing but the liquid fund, ultra shorts, and the FDs. Now, this is very critical when you invest into arbitrage fund. As far as this investment timeline is concerned, I think anything beyond 3 months is a decent timeline to invest into arbitrage funds. Risk, as I reiterate, there is virtually no price risk on these funds, and the returns as between the comparable categories, funds I intend to generate higher return than the comparable categories. Liquidity, I reiterate the fact that because these are mutual funds, you can entry exit anytime you feel like.
Sailesh, also, we are seeing this fund category getting popular among investors. So, according to you, what recent trends have been observed in the inflows and popularity of arbitrage fund among investors? If you could just highlight a few, since you also have a very special kind of an arbitrage category fund.
So yeah, so the inflows have been thick and thin in this fund. I think this category has always lived, have seen large inflows coming in. The last 1.5 year has been very good as far as the returns are concerned. So what is very critical for this fund is that this fund needs the large breadth in the market. So if your breadth in the market continues to improve, these funds will definitely generate higher return. Also very critical is that you need large participants, market participants like the retail and the HNI coming in, because those are the typical leverage buyers in the market, typically buying or investing into markets to the futures, which hypothetically means that they are actually helping the cost of carry. So my only point is that this funds definitely needs these funds can actually continue, though we have seen large inflows coming in, because the markets have grown from in last 2 to 3 years, wherein the arbitrage funds have AUMs have also swelled. They hypothetically, with this retail participation coming in, will definitely continue to deliver decent returns. I mean, what is also critical that you this also has a play on the interest rate. So if your rate come down, the absolute return from the arbitrage fund can also come down. But you also need to take into consideration that these funds are comparable to liquid fund, ultra short, and because they are lesser exposed to interest rate versus the funds which I mentioned, they will continue to generate higher returns than those funds.
All right.
And this is, yeah. So
Sure.
risk wise,
Sure.
yeah. So they are as safe as you can think of, when because there is no price risk on these funds.
Absolutely. But then, Sailesh, I'm sure you would also agree that there is no category which is without any risk, any category that is risk proof. Okay, there is some kind of a risk associated everywhere in all kind of categories. So, talking about potential drawbacks, are there any limitations or risk associated with arbitrage funds that investors should be aware of?
Yeah, so fair enough. I think there is no category where there is no risk. I totally agree with that. On the arbitrage fund, what is also important is that if the market loses momentum of that, or if market goes into a drum rolls where market just doesn't move anywhere, the cost of carry can come down dramatically. We have seen those scenario which can actually drag down your return. In a scenario where if there are global turmoils in the market and market loses momentum, that can also lower down the return. We have seen some period when some regulatory changes happen, volumes drop down. So lower volumes in the market can also ensure that your spreads get impacted. Significant large inflow into the arbitrage fund can also typically impact some amount of the spreads. So yeah, there are some risks associated with the arbitrage fund, but in generally those risks are typically much lesser than what we see or what we experience into an equity fund.
One last question to you, and then we'll wrap up this discussion, Sailesh.
Okay.
Given the current economic indicators, what is the future outlook for arbitrage fund in the entire investment landscape?
So I think if this fund should definitely be a part of your portfolio. One, it gives you stability of the return. Second, it bears no interest rate risk, neither a downgrade nor a default risk, which other debt funds may have. But I would hypothetically say that with the current economic conditions, if somebody is looking for a stability of return, lesser risk, they want linearity of return, then definitely arbitrage fund stands tall. Reiterating the fact that definitely everything can't be parked in the arbitrage fund because there's a limitation to kind of return what you can generate. But definitely it should be a part of your portfolio. There is no doubt about it. Anybody who's investing into a liquid, ultra short can definitely, or into fixed deposit, can park some of the money into arbitrage funds here. I would not say that everything should be parked there, but at least a part of your money, because this fund one has the potential to generate high return. It has tax advantage, and there is a linearity of return. Again, most every arbitrage fund or most of the arbitrage fund typically are obviously they don't carry any price risk, and that is why I am of the fact that the money which is locked in is actually your profit at the initiation of the trade. So I am of the view that definitely this should be a part of the portfolio. Not everything against your FDs and your liquid funds or ultra short, but some of the money which is parked there can definitely be parked there.
All right, I think that will be all, and it's almost like a classroom or an arbitrage fund that we did. And thank you so much for being on the show today and helping our viewers understand this category. Thank you so much, Sailesh.
Thank you, ma'am.